Four Corners podcast.
How do you think 2021 plays out?
In 2021, it really is the year of the vaccines. Now, it's not even around the world. In the United States, we think it will wind down over the course of the second quarter.
Are there any things that you feel that aren't getting enough attention, is completely disconnected to the pandemic?
Central banks got into the game of trying to help the economy out. That doesn't work. It is a testament to the arrogance of central bankers. They don't really admit that.
What are your thoughts on things like cryptocurrencies?
They're nonsense. There is nothing about Bitcoin that makes it worth more than the price of a cup of coffee.
Hello and welcome everyone to the next episode of the Four Corners podcast with your host Klisman, Murati. And on this episode, we have a very special guest with us today. We have Dr. David Kelly, Chief Global Strategist of JP Morgan Asset Management. And we're here today to talk about all things strategy, how David views the markets and what his thoughts are on how 2021 will develop into 2022 and beyond. So thank you so much, David, and welcome to the show.
Very glad to be here.
Wonderful. Thank you so much. So the first question I'll put to you, and this is something that I've been thinking about, especially as COVID has almost taken full focus of the investing world, is how do you think 2021 plays out? Because in one of your recent reports, you mentioned that 2021 will be the end of COVID with the rise of vaccines. How do you see this playing out in the real world? And how will you respond? How will the investment community, do you think, respond to this?
Both 2020 and 2021 are dominated by the virus, and the pandemic. But I think the difference is that in 2020, it was the year of the virus and we had this huge global recession. In 2021, it really is the year of the vaccines, and we're seeing this vaccine rollout. Now, it's not even around the world. The UK and the United States are doing very well in terms of vaccination, so is Israel. Continental Europe is lagging behind. I think Asia is lagging further behind that. But I do see, our pharmaceutical companies have done a very good job in creating vaccines which are safe and effective as far as we can see. And this does seem to be having an impact on the mortality numbers already. And I think they will have an impact on crushing the pandemic over time. You don't need everybody to take the vaccine to crush the pandemic. I mean, personally, I jump at the chance to take a vaccine because of what the pandemic has done to us all. But there is a large number of people who now have some immunity because they caught the disease. And in both Europe and the United States, the combination of those who have immunity from catching the disease and those who have been vaccinated will, I think, cause the pandemic to wind down. So in the United States, we think it will wind down over the course of the second quarter. By the time we get to the 1st of July, it will be pretty much, I think, beneath the surface. I think it'll take a little longer in Europe and a little longer in Asia. But by the end of the year, I think the whole world will be coming out of the pandemic. And that will lead to a very natural, strong surge in economic activity. All the service sector activities that people have not engaged in, I think they will engage in. So we're looking at a very strong rebound in the global economy, particularly in the United States. That does mean higher interest rates, it means higher profits, but it does, I think, have profound implications for the investment environment, because it's quite a different investment environment this year, obviously, from what we saw last year.
Naturally. But from the conversations I've had with some investors and some of our clients and audience, it seems as if because this impact of how coronavirus has impacted the markets, it's been very different to how other global events have impacted the markets. You think back to the Great Recession and other financially caused financial fluxes, whereas this is a whole different dimension of risk because it comes from the health sector, something which investors don't have expertise in. It's the doctors that really have take the lead on how we will come out of this. So being that is the case, this blind spot in understanding what the future will hold, do you think we've seen sort of a wait and see response from a lot of people, or have in your point of view, have people been aggressive in taking advantage of the unpredictability?
Well, I think, recessions, if you remember the opening lines of Anna Karenina, it is that all happy families are happy in the same way, but all unhappy families have a unique way of being unhappy. And I sort of feel the same way about recessions. They're all bad, but they're all different. And this one is perhaps the most different of all. And that does mean that from a modeling perspective, for example, I've run a macroeconomic model of the US economy for the last 25 years. it's really hard to you have to manhandle these equations and these series in order to try to come up with a plausible forecast of what's going to happen, because there is no past experience in modern history of how a pandemic affects the economy or how the recovery from a pandemic affects the economy. But I do think that professional money managers are not waiting to see. I think what you have to do is think logically about, okay, what the pandemic did, but then let's look at the disease, let's look at the vaccines, let's look at the path, let's think about how industries will react to this, let's look at fiscal policy, monetary policy, and you build a framework, a most likely scenario for how things are going to work out. And particularly if that involves dramatic change from where you are, then you do want to put your money where your mouth is and make investments while the opportunity is there. And I think in many ways, that's why the market bounced back very strongly last year after the pandemic hit, because I think a lot of professional investors took a close look at how bad the pandemic was, but also the large chunk of companies that would be able to get past this, and also the fact that there is an end date to this thing. If you make the bet that the biotech industry will come up with vaccines, then you know that this is a book-ended recession. It starts with the virus, it ends with the vaccine, and that's not usual for recessions. You can't usually, usually you crawl out of recession. This one, we're going to bounce out of the recession when the vaccine is fully deployed, and that's so we basically had to put that into our models and try to figure out what all that means for markets. We couldn't wait to see what happened, because then the markets would have moved ahead of us, and we'd have missed out on some good returns.
Yeah, and what do you think are the kind of lessons that you've learned personally yourself throughout this period? You mentioning, apart from the Spanish flu, we've never had something as global as this before. So this must have been very new to you as well. Are there any lessons that you think you've learned which are primary in your strategic thinking? And how will you take them on into 2021 and beyond?
Well, I think it's simply a reminder of the fact that we are very that as a people, we're very adaptable. I mean, humans just adapt. And so we were looking at companies that did adapt and companies that didn't adapt, but most companies simply adapted to this. I think that it has had some profound effects on things like business travel and office usage going forward. So I think it will reshape the environment. I would say that, we do take a long look at history. And I mean, I'm a history buff. I love history. And I think I see a lot of human behavior which repeats itself over the centuries in a fairly predictable manner. But so much else about the environment does change that you can't really take the lessons of history. I mean, if the Spanish flu, of course, was a similar kind of pandemic, whereas a pandemic with no hope of a vaccine, and it was a pandemic in which people would more or less go about their lives because they knew there was no point in waiting for a vaccine. So it had a terrible toll. But we knew the economy would react differently to it. And also, of course, there's no, the things that you can do with electronic communications in this economy means that there are practical ways of avoiding getting infected today, which just would never have been available a century ago.
For sure, for sure. But it seems as if a lot of the conversation I've heard on the news, and even when you read the papers, is pandemic focused, but realizing that the world is still moving, businesses are still operating, world that doesn't stop because the pandemic is here. Are there any things that you feel that aren't getting enough attention that you may be focusing on, which is completely disconnected to the pandemic? Maybe geopolitical shifts or issues in relation to trade or any other unique aspects of the world that aren't getting the attention that is needed, especially given that the COVID virus is front and center?
Well, I think the most important thing that is, that investors may be overlooking here is related to the pandemic, which is the way that monetary policy and fiscal policy has reacted. So if you turn the clock back to the end of the great financial crisis, after the great financial crisis, central banks became very active. They had to be active during the financial crisis because it was a financial crisis. And so they got into the game of trying to help the economy out. And that makes a lot of sense when you've got markets which are frozen. It makes a little less sense when you're trying to use low interest rate policy to stimulate stronger aggregate demand, because frankly, that doesn't work. It is a testament to the arrogance of central bankers in general that a decade after the great financial crisis, they don't really admit that. And you can still see central banks using very low interest rates or negative interest rates to try and stimulate the economy. Now, what they can do, of course, which is much more powerful, is they can enable central governments to run aggressive fiscal policies and with cheap financing. And that is what's happened this time around. So this is all about the fiscal as opposed to the monetary. But the thing that I think investors are perhaps missing is that this combination of very easy money and very strong fiscal stimulus is heating up an economy, but also heating up capital markets. And so we've seen a very long period of time in which financial assets have grown more than the economy overall. We're now supporting a mountain of financial assets on top of the real economy. And I think that people are perhaps complacent about the dangers of a monetary and fiscal policies which have entirely turned dovish and which there's no restraint at all.
Mm-hmm. Okay. Turning the page to a different chapter now, moving completely away from the pandemic and more towards understanding the rise of China. Now, this is a piece that everyone is speaking about. And from the past interviews I've seen of yours, and correct me if I'm wrong here, but it seems to be your perspective that as China rises, the best thing that the West can do in terms of engagement is see if they can bring them on side with terms of opening up their markets and transitioning them into a democracy, or having more democratic aspects of their political system be present. Because fundamentally right now there seems to be such a difference between the Chinese way of doing things and the Western way of doing things, which may hinder companies who want to enter into the Chinese market geopolitically. Would that be a fair assessment of your view towards China? And how can you give our audience a much more thicker understanding of your perspective of how China and the West develop in 2021 and beyond?
Well, I think it's very important to have a strategic approach towards our relationship with China. I think that the best way of looking at this is if you think about our grandchildren in the 22nd century, as they look back at the 21st century, they will recognize that one of the great themes was the struggle between China and the West. And it is a struggle, China is growing in terms of its influence. It probably will have the largest economy in the world in terms of GDP by the 2030 and perhaps by 2027 is what we're calculating right now. So it is growing and it cannot be ignored. I think the relationship between the United States and China is really a multi-dimensional relationship. There are areas in which we must and should and are willing to cooperate, such as on climate change or on things like a pandemic or things that affect the whole world. We need to be working in cooperation. We have such mutual interests in, say, in controlling nuclear proliferation or climate change. So these are things we need to do. There are also areas where we are going to confront China in areas of human rights. I think the West, and this is not just the United States, but the democracies of the world feel very strongly about the right of free speech and the right of self-determination of individuals and the right to vote. These are fundamental to how we feel about the world, and these are obviously not values shared by the Chinese government that we currently have. And so, there will be a level of confrontation. There must be, if there are human rights abuses or there are other ways in which China is behaving in a way that we just find in the West completely unacceptable, then I would expect to see confrontation. But then there's also going to be a big area of competition, which is somewhere in between, where we just try to play a game and try to make sure that, in terms of trade, in terms of technological achievement, we will compete with each other. We will want to make sure that there are fair terms of trade, that we do everything we can to advance technology. They do everything they can to advance technology. We try to, I think the world will want to try and deal with poverty, and China will want to help its people move to greater levels of income. So there are, the competition may well be good. It may make us all a little faster, a little smarter, but it's a very multi-dimensional thing. And from a US perspective, I think it would be naive of us to simply think that we can put up a wall and just try to fight China at this point, particularly on our own in the United States, because the United States is simply not big enough in the world anymore to be able to bully the Chinese government into doing what we want. I do think that one of the approaches that the United States should take is by knitting its relationship with Western Europe, with Canada and Australia and Japan and Korea and Taiwan, knitting those relationships closer, trying to, when we think about competition or the areas we want to confront China, try to act in a unified, in a balanced strategic way, but try to take advantage of the economic power and the people power of all the democracies in the world, rather than just the United States on its own. Because I think that does give the West still a strategic advantage over China, which again, sometimes it's a matter of cooperation, sometimes a matter of confrontation, sometimes a matter of competition. But in whatever the relationship is, it's always important to approach a relationship from a position of strength. And I think the West's strength comes from the ideas of democracy and the common ideas of democracy and self-determination, which I think the Western Europe and the United States and countries like Japan and Taiwan and Korea share.
Yeah, I think you're right in saying that, because especially from our analysis, or my personal analysis on the rise of China, there seemed to have been a big enthusiasm from the United States, even during Reagan's time, that if we get close to China, that will cause a rift between China and the USSR. But as time has developed and time has passed, the West, and especially America, have been hopeful that China will change and become more democratic, with no avail. And I think they've given up these ideas, at least in some circles, but that still leaves the fact that it's still a very big country with many different resources at its disposal. The foremost being its populace and the size, and also its ability to create or be the factory of the world, and now its identity and its strategy is changing. Given that, as you mentioned, I think it's a battle between hearts and minds, really, because would you rather live in a part of the world where ideas of democracy, free speech, free trade, and open trade are valued, or would you rather live in the opposite world? Saying that, if you were to be in a position where you could somehow influence the dynamic, do you think investors have power to influence, or are they simply how can I say it? They're at risk of just being influenced by geopolitics, or do they have a role to play in making sure that the standards that we set in the West are upheld, especially when you have issues with China, or are they simply the receivers of the geopolitical chaos that is caused between these two big powers?
I think business relationships are generally positive. I think investment relationships are generally positive. The more that China is invested in the United States, the more that US investors are invested in China, the West is invested in China, the more common interest we have in finding compromise, finding solutions, because we've got more on the table. The two countries which have got no economic relationship at all can fall out or have some conflict without paying such a price. But the stronger those economic links are, the more both sides have to lose from confrontation, and that may open a path towards compromise. I'm not naive about this. I mean, I've rarely seen a circumstance in the world where a ruling group, freely gives up its power to some other group just because either the people demand it, or some outside country suggested that would be a nice thing to do. So I'm not naive about that. But again, from a Western perspective, we share one world, and there's only so much you can achieve. And while we may, I don't think anyone in the United States would exactly choose the Chinese form of government as a preferable form of government. There's a limit to what we should be willing to give up, I think, to change that, particularly given the potential for, as you said, chaos in the world if you sort of bluster around and try to deal with these problems.
Yeah. And do you think, from your foresights and your strategic analysis of the world, are we set to experience more geopolitical chaos moving forward into the future, especially as more nations grow and they develop on at least what we call their centers of power, meaning they have specific aspects, each nation have tools at their disposal that they can use to influence their world or influence their region as they see fit? So things like their active consumer market, their growth of their economy, their military balance, their technological leadership, and others. And as more nations develop on all these six sides, as a few more, they become more powerful. That's our idea anyway. And we will see more geopolitical chaos. Is this area of the rise of geopolitical risk on your radar when you look at the investment landscape?
Well, the two issues: is geopolitical risk really rising? And then the second case is, how can you hedge against geopolitical risk? So I think it's still an open question. I think clearly the long-term threat from nuclear arms is growing, and that's nobody ever talks about it. And I hope to God we don't have to think about the year in which nuclear power or nuclear weapons really turned our world upside down the way this pandemic has this year. But it's out there, and that is getting worse over time. I think we're also in a situation where in a lot of democracies, populism rules the roost on both the left and the right. And I frankly find populism very dangerous, because democracies depend upon well-informed well-informed voters making logical decisions. And that usually supports, centrist, moderate governments. And that's what you want to see. Populism is really an appeal to sort of shut off the left side of the brain and just do what feels good, or whether it is following a right-wing bumper sticker or a left-wing bumper sticker. But I think populism undermines democracies and empowers autocrats. So I do worry about that. But I'm not sure that the tide has entirely gone in that direction, because while I can see political power, in recent years has moved a little bit more towards the autocrats, I also see, advances in education. I mean, we see a greater and greater proportion of the people of the world are receiving not just a primary and secondary education, but more college graduates. And over time, the more educated people are, the more people understand the science of how this world works, the greater is, I think, the probability of at least a majority of people wanting to achieve sensible policies. And then it's just how do you help people see the honest truth about where countries are, or what policies make sense or not. And that's it's a challenge. It's a communications challenge. But I'm not sure. It's easy to say uncertainty is always rising or geopolitical tensions are always rising. But if you look back at the last century on World War I and World War II, and the Cold War, it's not clear that this moment is more dangerous than those moments.
Mm-hmm. Well, I guess to that level of having a world war, not so much so, but with the introduction of you can say with the introduction of nuclear weapons, the world has become more peaceful, because they know what impact it will have if two nuclear powers go to war with each other. But regionally,
Yeah.
I think I would say that the world is much more active, because the superpowers aren't the only thing that matter anymore. The USSR, China, and with the West, or the UK and the US, aren't the only big players anymore. The Security Council is there in name, but in terms of active movements and active geopolitical issues, they're very much regional, with players that didn't really have a voice even 20 years ago, now having much more of a voice, although not to the level of a world war, but they have a chance to express themselves through the use of their power, whether it be increasing tariffs because their consumer markets are now bigger, so that's a pull for them, because they can use that as a bargaining chip with other nations if they need to. So it may not be to the level of world wars, but I'm happy that at least the focus on the rise of nuclear proliferation is on your radar, because you're right in saying that hasn't really been talked about at all in the investment community. Typically, from what I hear anyway, it's macroeconomic issues that are talked about in 99% of circles. And when you introduce ideas of geopolitics, it's unless there's something big, then we're not going to focus on it.
Yes, and I think, to your point, I mean, I do think that technology empowers the individual. And that, in some ways, that's why small powers or small groups or small terrorist groups are far more scary today than they would have been in the past. I mean, if you turn the clock back 200 years ago, if you turn back to, say, the Napoleonic Wars, the power of a nation, the relevance of a nation depended entirely upon its ability to wield an enormous military and send an army, across land or sea. And that's just not that's not the world we live in anymore. So we have a right to be worried about people a few individual players in cyberspace or in dealing with various potential weapons of mass destruction, or even using technology in clever ways, obviously in 9/11 against a superpower. So it is a more complicated world in that sense, because it's not just a simple manpower issue in terms of your ability to wage war that defines some of the threats that exist around the world.
I think you're right. The way that I like to think about it sometimes, David, is saying that risk is like energy. It can't be destroyed or created, but it can only be transferred in different ways. And that's what we see, I think, happening now. You mentioned in the Napoleonic times that the biggest military, the strongest military had the biggest power, which is why I think, Napoleon never really challenged the UK through naval war, because he knew that their navy was the strongest in the world. But as time passes, the world changes, and we believe that there are four major things that will impact the world the most in the next 100 years, which is, globalization becomes a bigger issue, and all the things that are related to that. Geopolitics in different ways becomes a big issue. The use and development of transformative technology, and also societal change. So increasing education of the populace. If you take that to the next logical conclusion, they start demanding more things from their governments and more things from the companies that they buy from, which then impacts the investing world, which is why we see things like ESG becoming important, because we have a much more, you'd say, educated consumer base, which is then demanding more green products. So this trickle down into the investment world comes from different parts in different ways, which is important for anyone looking to be active in the markets. They need to really have a focus on. Going on to one other thing, in your report that you sent me before this, you mentioned, and I quote here, the greatest risks are generally the most unanticipated, which I think is true. And in the list of risks you mentioned a lot of financial risks here. You mentioned the collapse of the tech bubble in 2002, the global financial crisis of 2008, the Asian financial crisis of 1998, and European sovereign debt crisis of 2010. But would you say that these financial crises could be seen because they are created by the financial world? Things like a pandemic, maybe not so, because it has no relation to finance. But if you see the 2008 crisis, for those who were paying attention to what was happening, especially with the new financial concoctions that were happening in America, seeing how this could play out, someone could theorize this could be a big problem. Just like now we're talking about the pandemic having a big problem on the tail end. Surely these risks that are mentioned are predictable in some way, shape, or form. But things that can't be predictable are things which are maybe not related to the financial world. Have you got a comment on that?
Yes, I think economic risks are easier to look at, to forecast, than financial risks, because, for example, in the 2008 financial crisis, we could see that there was a problem in the US housing market. There was no doubt there was a bubble there, and there was a bubble related to subprime mortgages, and it's because of years of deregulation in that area, where and banks being basically able to make and making mortgages and packaging mortgages. But you could see the problem. But what was quite opaque was the level of risk within the derivatives market, because what really happened in the fall of 2008, it wasn't just the housing; it was all these credit default swaps all across Wall Street and around the financial world. We had all these derivatives with a colossal notional values. Now most of it should cancel out, but it's very difficult at any point in time to know exactly how it all cancels out. And what's more, we'd set up a system where they all cancel out if everybody pays the bills. But the problem was with the structure of derivatives, that if you had one bad player at the table who promised to make good on all these bills, and then actually went bankrupt, then suddenly the whole edifice looked difficult, and there was no way of knowing who was broke or who wasn't, and that caused the whole credit markets to freeze up. Now, in hindsight, it's easy to say, oh, that was inevitable, but it wasn't inevitable. I mean, first of all, we could have avoided it altogether if we had been as bold in dealing with Lehman Brothers as we've subsequently been in dealing with other financial crises. But also, it wasn't clear that the full scale of the Federal Reserve wouldn't move appropriately, and the federal government wouldn't move appropriately in passing TARP fast enough. So in hindsight, these things look obvious. At the time, it wasn't obvious that this would, the subprime crisis in the US would turn into the global financial crisis. That wasn't obvious at all. But I do accept that at least economic issues, financial issues, may be a little easier to see But I think we always assume this sort of normal distribution of risks based on what we've seen in the past. And there are black swans. The pandemic is a black swan. I said, nuclear could be a black swan. Meteorite, an earthquake,
Anything,
could be a huge problem. It's hard, admittedly. I mean, the fascinating thing about the pandemic is it would have been really hard beforehand to come up with any crisis, no matter how bad, which would actually zap the entire world at the same time. And the pandemic did that, as did the global financial crisis. That's very unusual. It's hard to think of a third example of something beyond thermonuclear war, and then who cares?
Exactly. For sure.
But it's otherwise it's hard to find a global problem. But it's the point I make though is that these things are unpredictable, and you hedge against predictable risks. You diversify against unpredictable risks, and that's one of the major argument for diversification is that you don't know which way the next shock is going to hit you from, or what direction it's going to come from.
Yeah. Would you say also when the issue of or the topic of a black swan comes up, do you think black swans exist for different people in different ways? Because if you're focused, if you're an investor who may have an interest or a focus on viruses or on aspects which could lead up to a virus, then that wouldn't be too much of a black swan for you, as opposed to if you were an investor which was focused more on something else. So would you say that black swans aren't universally applicable to everyone? It would depend on what your focus is at that time and what you can see as signals, which then you can take and use to your advantage. For some people, some things are black swans, but for others, other things are deemed as black swans. And when you listen to it on average on the media or on TV, things like the pandemic could be a black swan for maybe the vast majority. But for those who may have done their research in different ways, then they could have seen how they could potentially hedge against something like this, maybe not knowing the full impact, but knowing what they would do just in case this would come up. Saying that, do you think the investment world and perhaps even yourself are developing more robust measures of looking at the world to see what the next potential black swan could be, and putting bodies and minds to these problems of the future?
Yes, I think we're putting more effort into it, but I am somewhat skeptical of our ability to do something solid about it, because very often you have something which is a small risk and then suddenly it happens. And if you're trying to buy an insurance against that small risk, if you maneuver the entire portfolio to try to protect against that small risk, you will lose out in 19 out of 20 scenarios, and you will make out like a bandit in the 20th. And let me give you an example. I'll tell you another black swan.
Okay.
The 2020 election, not the 2020 election, the 2000 election.
Okay.
Back in 2000, when George W. Bush beat Al Gore, he beat him by a few hundred votes in Florida, which is the equivalent of basically you fill a football stadium with people and one person moves their seat. And it was an unbelievable fluke in electoral history. It just is. It shouldn't. The probability is zero of it happening. How could you have protected against that? You could have protected your portfolio against a close election. You could have assumed that we'd have a sell-off because of a close election, or that might cause a recession. But if you position the portfolio for a close election and a recession, and then most likely that thing doesn't happen, then you're actually losing money. I would say that also about the subprime crisis. Most times the subprime crisis would simply have been a U.S. crisis, like the savings and loan crisis, and it would have gone away. The same thing a little bit with the pandemic. You could have said Ebola might have been the same thing as COVID, or SARS might have been, but it wasn't. So it's a little hard. You can see the problem, and it's always important to be aware of the problem and think about, well, what if this happened? But it's a lot of these black swans really are unlikely events until suddenly they actually happen.
Yeah, it's very difficult, especially given what people see as being an effect of a potential outcome. You mentioned the election. You, for example, may have an opinion that, let's say, if Biden, well, this is before the election, but if Biden comes into office, there'll be a massive sell-off because of his rhetoric towards high taxation or whatever. Whereas someone else would say, well, if Biden does get elected, then we see this as being a positive or a negative, and that will play out in the markets afterwards. And whoever's right will be seen. But it's not necessarily the case that all evaluations of an event are the same, which is why we see such volatility before and after something like an election, where you see two candidates, especially in America, obviously, where they at least pitch to the world or to the UK populace what their plans are for the future. And if you can trade off that, if you can somehow predict what the election will be, then you'll be in a good position. But for other things, it may not be as clear cut and as simple, especially as something like a pandemic develops over time. You don't, without knowing what the end point will be, it will be up in the air for a lot of it.
There is one other thing that I think you could say
on, yeah.
about this. Is if you have a shock, and the first thing that the shock does, it creates an enormous cloud of uncertainty, and that usually will cause markets to fall. But one of the most predictable things is that cloud will then dissipate. I remember, quite a few years ago, they had a terrible earthquake in Fukushima in Japan.
Yeah.
And it knocked out supply chains. It caused a terrible tsunami. The Japanese economy was very badly hurt. And for a few days afterwards, and of course we had the issue of the nuclear plant, which was even more
2011,
scary.
yeah.
But for a few days after, there was tremendous uncertainty about what all this would mean. But then over time, there wasn't a nuclear catastrophe, and the risk of a nuclear catastrophe fell sharply, and markets bounced back. And the same thing with elections. One of I never like to bet on an outcome of election because if it's close, it's close. But also I recognize that very often after an election, even if the outcome wasn't exactly what you wanted, one thing that has happened is uncertainty has fallen. And as uncertainty falls, market tends to go up. So it's it's actually quite a predictable result to have the stock market rally once the certainty of an election result is there, because it's less uncertainty should be positive for equities.
Yeah. So the last thing I want to get into with you David, is the difference between understanding. I mean, I remember in a past interview you gave is that although times of volatility or unpredictability like a virus comes along, what really matters at the end are the fundamentals of companies and how they actually operate. And that's what you should be basing your investments on. But it seems as if with the rise of different kinds of bubbles and momentum investing becoming so prominent during the pandemic, things like fundamentals, you can comment on this, but many see this as taking a back seat to following trends and to capitalizing off of people's fears. Do you think there is such a thing happening now where fundamentals are not being paid attention to as much because the world isn't in a place where you can really rely on fundamentals as an indicator for value when you invest in the stock market?
Well, I do think that investors are more focused on momentum and have been for the last few years, and particularly during the pandemic, than fundamentals. And I think that, again, I think that was going on before the pandemic and the run up to the US election. And then when the pandemic occurred, I think it became even more the case. And really, I think also gets back to this uncertainty issue, because when the pandemic occurred, we had massive amounts of uncertainty. So we had uncertainty in politics, we had uncertainty on how the pandemic would play out. And if you're out sailing and a big fog descends upon you, what you try to do normally is you just keep sailing the same direction but slower. And I think what happened is the people who were betting on large cap growth stocks just double down on that bet, or people who are betting on long-term government bonds again double down on that bet. And so you saw an extension of momentum investing, which actually added further distortion to markets. But as the smoke clears, because I think 2021 is a year of greater clarity when we see how the pandemic might come to an end, when we've got greater clarity on government policy, as that happens, then I think valuations become more important, particularly if you have a correction. Because if when everything's going up, people are happy to just not think so much about what's causing things to go up. But when everything falls, then suddenly people's attention is drawn by that, and they start thinking, well, what is it that I own? So this kind of environment is very good for mega cap growth stocks, for things like Bitcoin and various other speculative assets. But in an environment where you had a significant market sell-off, I think those are the very assets that are most vulnerable as people think about, well, if everything goes bad, what's going to be worth the most? And so I do think fundamentals will matter more. And I do also think fundamentals matter more in the long run, because you have these cycles of enthusiasm or despair in markets, which will either make or break momentum investors. But in the long run, I think valuations do have a greater impact. And in fact, there's plenty of empirical work which suggests that those fundamentals of valuations really matter much more for long-term returns than short-term returns.
Yeah. Do you think then, in terms of, as we mentioned before, investors are now not only focused on the big financial capitals of the world, but we see as countries develop, we have financial centers and asset managers and family offices develop in different parts of the world. So, a rise in liquidity in general is being seen. And the first place that they may go to are more established markets like the US and the UK, Europe, and others, and then parking their money in stocks there because they see it as being the best ROI for them. And actually, when this happens, we see a rise in the stock price that may be linked to fundamentals, but because there's so much liquidity that is going towards these stocks, it distorts the value of that stock at that price because there's so much popularity. So the fundamentals are doing so well, perhaps, that we see more money going into them. But then as that stock price goes up, it doesn't justify the price, but there's so much money out there going towards them that it causes an issue. Is there something that you can say about that, or is that a thing that you see happening?
No, I've always believed that enough money will ruin any asset class, and we've seen for many years. And I think what's going on right now in markets is we have multiple little bubbles on top of a broader bubble in financial markets, where financial, stocks, bonds, or alternative investments, they're all priced pretty high relative to the output of the value of GDP produced in the U.S. economy or in the world.
Yeah.
And I do think that that's a problem, but it won't last forever. I mean, it's we go through these cycles, and right now we're in a cycle of a lot of momentum of people bidding up various asset prices. But again, eventually, some of these bubbles will burst. Maybe a lot of them will burst at the same time, and then those assets which really have fundamental foundations will do much better in relative terms.
Okay. And finally, then, when we speak about bubbles, many say that ESG could be a bubble. Obviously, the pandemic has caused, a distortion of asset prices because of momentum. What are your thoughts on things like, even if you give a couple of minutes on each, the phenomenon of the rise of ESG investing and the problems with that, or the value in that, and also things like cryptocurrencies, Bitcoin, Ethereum, and this new innovation of NFTs. Have you got any thoughts on these topics?
Well, on ESG, I don't quite see that as a bubble. I do think there's a lot of enthusiasm around ESG, but there are a lot of regulatory issues which I think will force the pace of ESG, particularly the environmental side of this. I think there's enough regulation, there's enough tough goals that there will be new money deployed to try to help green initiatives. And so I think I think that perhaps every asset in that that is seen as a green technology. Maybe there are many that are overpriced, but I think the enthusiasm for this is going to continue because, frankly, the climate is going to continue to get warmer, and we do see a rise in green parties around the world. I think there's more interest in it among the voting public. So I think that will continue. On cryptocurrencies, they're nonsense. And they are nonsense. And it's fascinating to me because I've seen this so many times before, and there have been many examples over history, but there is nothing about Bitcoin that makes it worth more than the price of a cup of coffee. Yes, it's blockchain technology, fine. But there's nothing to stop me from setting up Zitcoin or Mitcoin, or my favorite personally is David Kelly coin. And I promise to only hold 20% of the issues myself. Everything else you can get into the ground floor, please step right up. But it is nonsense because there's nothing that guarantees its convertibility into gold or one of the world's leading currencies. What's more, it is a threat to authorities around the world because its best use is for money laundering. It is not a useful currency in that it's not a store of value, a unit of account, or a medium of exchange. And unfortunately, people are excited because it's going up, and they pretend to understand it, but they don't understand it. And then it gets a further veneer of respectability from financial firms who say, "Oh, we will trade this, or we'll set up an ETF in this, or we will do this, or we'll do that." And blockchain technology, I'm sure, is very useful. And I think that there will be reasons for digital assets going forward, as opposed to, for example, people carrying around euro notes or dollar notes in their pocket, yes, you can see some growth in this. But the idea of autonomous currencies where you're not to know who bought and who sold, and some mysterious person is the original founder and holder of all this wealth, this is silliness, and it will turn out very badly at some stage. And I just worry that too many individual investors will get lured into it. It's just a 21st century version of the emperor's new clothes. And I think that of digital art or whatever too. I mean, it's silliness. So
I see your point there. In fact, we had an interview with Dr. Savasavori. He is the chief economist of Tosca Fund Asset Management here in the UK. They manage over 4 billion in assets, and he said the same thing. But then you have other voices. For example, in America, you have very influential and wealthy billionaires who really promote the virtues of Bitcoin and other cryptocurrencies as being the future of currency. I mean, do you think there's some sort of reason behind that? I know you're sort of a trained economist, and you've seen these sort of bubbles perhaps in the past, and these innovations come to be in different forms. But if you were to sort of be the devil's advocate and justify the use of Bitcoin, is there anything you could say that would give you confidence, or that would give these prominent people confidence in its value?
No, it sounds cool. I mean, crypto sounds pretty cool. So it sounds cool, and yes, you can use blockchain technology as a fast way of doing transactions. But to be honest, if I use my credit card for a transaction, it's pretty darn fast. I mean, it's I don't have any. There's no the general public business is not slowed down by by the snail-like pace of transactions. That's absolutely not true. I think that there is some advantage in digital currencies overall, but then the problem with that is that currencies. I mean, it's a currencies for a simple transaction, but in people's financial lives, they have a set of complex transactions. I mean, I don't just pay my cable bill this month; I pay my cable bill every month. Do I want to be making a separate Bitcoin transaction every month for my cable bill? No. Could I set it up so that I make a cable bill transaction every month? Yes, but where does a bill come? And so you technological infrastructure around, and that's the simplest of transactions. So I think it's not well designed for complex financial transactions, and also the other side of the banking industry finances investment. So I wouldn't particularly want to undermine the banking industry by making transactions costless, but and then somehow get the central banks in the business of trying to balance your checking account. I think that would be a bad idea. But more importantly, just because some smart people or some influential people think something is a good idea doesn't mean it's a good idea. I mean, every minority, fringe, silly religion in the world, and there are plenty of them, or political movement, they have some fierce adherents. And what's remarkable about financial bubbles is, as Lincoln would have said, you don't have to fool all the people all the time. You don't even have to fool all of the people some of the time. You just have to fool some of the people some of the time, and you will have adherents who believe in this thing. They hear good things about it, and if so long as the market finds more skeptical, more willing buyers than sellers, the price goes up. The problem is that when you run out of people who are foolish enough to buy something, and then you realize there's nothing underneath it, that's when it collapses. And that's where that's what the tulip bubble is about. That's what we've seen. Same thing with John Law in France 300 years ago. I mean, over the years, it happens over and over again.
But surely you could say the same thing about fiat currencies. The fact that the gold, the dollar isn't backed by anything, and the value is in relevance to something else. Isn't that sort of, could you make the same argument for the dollar at the same time?
Well, well, it's easier to make that argument today than would normally be, but I don't really think that's quite accurate. First of all, gold is not a particularly good example, because gold, of course, at least it's a unique asset, but there's a truly limited supply, so it cannot work. A gold standard with a fixed exchange rate cannot work in the global economy. But with the fiat currency, so long as the central bank says that we will not allow the price of goods and services denominated in this currency to rise by more than, say, 2% per year. That's the stable inflation rate we're going to. That implies a control on the supply of that currency in order to achieve that inflation result. And so long as it is the only currency in the United States which is legal tender, which you can use for the settlement of all all transactions, and a central bank commits itself to maintain the value of that relative to goods and services sold in that economy, then it does give a degree of assurance to a fiat currency. Now, if you lose faith in that central bank or the government that appoints the member, the governors of that central bank, then you got a problem.
Yeah.
And I'm not a fan of MMT, which could well push us in a very dangerous direction.
Yeah.
But I do think that fiat currencies are more legitimate than something like Bitcoin.
Okay. Listen, David, I can speak to you all day long. I mean, this conversation has been amazing, and hopefully we'll have a chance to do this again next year or whenever we find some time. But if people want to get in contact with you, David, I know you're very active on LinkedIn, so I'm sure that would be the best place to go. But is there any other way that you feel you have open access for you to be contacted by? Do you use Twitter or anything else?
I actually think that's the best way. If you are interested in contact me through LinkedIn. I mean, I could give out my email address, my business email address, but that could get me
inundated with emails. So I think you should keep that for select people. Well, that's how we got in contact anyway. I messaged you on LinkedIn, and we managed to have this podcast. So you are responsive on there. So for the final time, David Kelly, Chief Global Strategist of JP Morgan Asset Management. Thank you so much.
You're very welcome, Klisman.
Thank you. Wonderful.